Hello and welcome. My name is Jonathan Stav, and here at Sectors Made Simple, we've created over 200 hours of educational content and unique investment tools, all for one purpose: to give you the knowledge and resources you need to invest simpler. Today, I want to introduce you to BPI. BPI is a unique way to be able to look at a group of securities and to understand in one simple number the performance and potential risks that market might have. This is something that you don't need much information to be able to start using and can benefit seasoned and new investors alike. So, with that said, let's take a look at what we'll cover in today's video. In today's video, we will cover what BPI is, how BPI is calculated, how to read a BPI chart, and how BPI data can be used to help our investing. So, let's get started with the most basic question. What is BPI? BPI is an acronym which is short for Bullish Percent Index. And to really understand what it is, let's take each one of those words individually and look at what it means. First, we have bullish. Bullish is an investor term that is used to describe things that are typically going up in price or is in a positive price direction. Now we have percent. This one should be pretty straightforward. It means that this number, this BPI, is going to be a percentage. In our case, it's going to be a percent between 0 and 100%. Then finally is index. Index is a way to let us know that we are looking at a group of securities and looking at that group of securities to create a single index or a single number that we can use to represent that group. Let's put everything back together. Bullish percent indices or indexes are a percent between 0 and 100% that tries to look at what percent of the securities in that group or that index are currently in a positive or bullish trend. But what is a bullish trend, you might ask? Well, to answer that, we need to talk a little bit about point and figure, and more specifically, point and figure buy and sell signals. If this is something that you're not familiar with, don't worry. You can use BPI without really knowing much about point and figure or point and figure buy signals. But if you're really interested to learn more about that, we have covered both point and figure charting and point and figure buy and sell signals in previous videos, which you can find here on our YouTube channel. Now, let's talk a little bit more about how BPI is actually calculated. BPI takes advantage of one of the small quirks of point and figure, and that's that every point and figure chart is always in either a buy signal or a sell signal, whichever's happened the most recent. Now, to actually calculate our BPI for a group of securities, what we have to do is look at the point and figure chart for each one of those securities. For every chart, we find if that chart is currently on a buy signal, and if it is, we write it down. Once we've gone through all the charts, we add up the total number that are currently on buy signals and divide it by the total number of securities in that group. Just to put some numbers out in the air so we can use them as an example, let's say we have 10 companies, and out of those 10 companies, 7 are currently on point and figure buy signals. That would give us 7 companies on buy signals divided by 10 companies total, or 0.7. If we express that decimal as a percentage, that gives us 70%. That 70% is now our BPI, which tells us that 70% of the companies or securities in that group are currently on buy signals. Now, we can turn this BPI into a BPI chart by plotting that 70% on a chart between 0 and 100% and following how that number changes over time as more companies go on buy signals or more companies go on sell signals. Now that we've plotted our BPI on a chart, let's talk about how we can read that chart. There's quite a few different ways to make sense of the information on a BPI chart, but here are 2 of the probably easiest ways. The first is by using the chart to say if that group or that index is currently bullish or bearish. To do this, what we do is we place a line right in the middle of the chart at 50%. Any chart whose BPI is above 50% we would consider to be bullish, whereas anything that has a BPI below 50% would be considered bearish. But Probably the more useful way of using BPI is to try and gauge risk and create areas of overbought and oversold territory within this BPI chart. We can do this by dividing up our BPI chart into 3 sections. One is going to be BPIs between 0 and 30%. The next is going to be an area between 30 and 70%. And finally, we have 70% through 100%. Now, we can use these 3 different areas with some labels. We can call the area between 0 and 30% the oversold territory. And for us, we're going to label that as the green zone. We'll talk more about that later. The area between 30 and 70%, we're just going to leave as white neutral territory. And then finally, we're going to have our 70 to 100% be our overbought territory, or the red zone. Now, let's talk a little bit more about what those green and red zones mean as we go through some examples of how we can use BPI to help our investing. Before we go into how we can use these BPI charts, I want to mention that probably the easiest way to help make your investing simpler is by leaving a like or subscription on our YouTube channel. These little actions do go a long way for us to understand what content you're enjoying and would be interested to see more of in the future. But let's get back to the content now and talk about how we can use these different zones to help gain more information about the market. As investors, these BPI charts offer us a quick and easy way to understand the condition of a particular index or group. We can use this to our advantage, where we get to save lots of time not having to dig between individual charts and instead compare and contrast different sectors, ETFs, or markets to find which ones offer us the opportunities that we're looking for. To talk a little bit more about those opportunities, let's go back to those green and red overbought and oversold ranges that we had talked about prior. If we have an index that has a BPI of 70% or above, it means that we're getting into that red or overbought range. That means that the majority of the securities in that index are currently on buy signals. And while it's not always true, it means that there's a higher likelihood that some of the companies within that group have been overbought or are currently overvalued compared to what their fair market value might be. This also gives us a lot of room for correction if the favor of that group begins to turn sour and prices begin to correct downward. However, on the other side of things, in the oversold territory, which is that green 0 to 30% range, we have the opposite. There, we have securities that are mostly oversold, where the majority of these securities are currently on point and figure sell signals. This gives us a higher likelihood that individual companies might be oversold or are currently undervalued compared to what they might actually be worth, and gives us a lot of room for growth in both value but also in point and figure buy signals, which we can use as technical indicators to be able to find entry points for securities, and we have lots of room to grow as companies begin to improve and prices begin to correct upward. It's also worth noting that when we're talking about overbought and oversold ranges, it's not just a simple black or white kind of thing. We can think about this BPI scale as a big rubber band, where we have a rubber band that's placed at 50%, and the further we stretch away from 50%, either into that red overbought territory or green oversold territory, if we let go of that rubber band, the further we are from that 50% line, the harder it's going to snap. BPI works in a very similar way, meaning the further we are from that 50%, the more strain there is, where if the rubber band is let go, it's going to snap back harder and faster. We can use this to our advantage as investors, where we can find a BPI that is currently above 80% and believe that there's a lot of potential risk there, where the majority of securities are already on buy signals, meaning there's not a lot of clear and easy opportunities for us. And if corrections occur, they might be a little bit more significant than we would see if the BPI were just 60%. On the other side of the spectrum, we have our oversold territory, where a BPI of 10% means that 9 out of 10 companies are currently not on buy signals, opening up lots of opportunities in different companies, or an ETF that represents that entire index, where we can find when that BPI begins to reverse into the opposite direction. So, for us as investors, the number of BPI is important, but so is when it changes direction. So the things that we should be looking for in a BPI chart isn't just the percentage, but is the direction of it. And the areas of opportunity are when the BPI reverses, either negative. If you're looking at things like shorts, you might be interested mostly in where the BPI reverses negative above that 70% overbought line. Or if you're just buying long and trading normal securities, the biggest areas of opportunities for us there will be when the BPI is below that 30% oversold line and begins to correct upward. We've covered a lot of information in today's video, so let's quickly review what we've learned about. We learned that BPI stands for Bullish Percent Index, a 0 to 100% scale that we can use to show what percent of companies in a given group are currently on point and figure buy signals. This BPI can be broken down into indexes that are either bullish or bearish, depending on if the BPI is above or below 50%. We can also break out that BPI into sections of overbought, neutral, and oversold. Overbought is BPIs above 70%, implying that the majority of companies are currently on buy signals, and there's an increased risk if that group or that index reverses. Equally, we have the area between 0 and 30%, which is going to be the oversold territory, where the majority of companies are currently on sell signals, and if a reversal occurs, there is lots of room and areas of opportunity for companies to improve and go on buy signals. By understanding how this BPI number works in context, we can look at the BPI of many different indices to find the one that matches our current level of risk and interest, and find the opportunities that matter the most to us. Thank you all so much for joining us for this introduction to the world of BPI. If you found this information helpful, we would suggest taking a look at our website, sectorsmadesimple.com. There, you can learn more about the tools that we offer and create a free account. That free account gives you access to over 100 hours of educational webinars, much like the videos that you're watching right now, and are easily searched to find the topics that most interest you. Thank you all so much again for joining us, and we hope to see you all back very, very soon.